Property and Casualty Exam Outline. Welcome to the quiz. What is a retroactive date on a claims-made liability policy? Is it A, a date after which incidents must occur for coverage to apply under the policy? Or B, the date the policy was retroactively canceled? C, the date the policy was issued? Or D, the date a claim is reported? The answer is A. Claims-made policies cover claims first made during the policy period or extended reporting for wrongful acts that occurred after a specified retroactive date or retro date. Acts before the retro date are not covered, even if claimed during the policy. This limits the insurer's exposure to prior unknown risks. Not cancellation date, not issuance date, not report date. Retroactive date defines the earliest date of covered acts in claims-made coverage. Next question. In automobile insurance, what does non-owner coverage provide? Is it A, liability coverage for an individual who does not own a car but drives other vehicles? Or B, coverage for an uninsured vehicle? C, physical damage coverage for a leased vehicle? Or D, coverage for a driver excluded from the policy? The answer is A. People who don't own a car but regularly drive borrowed, rented, or others' vehicles can buy non-owner auto insurance, which typically provides liability and sometimes uninsured motorist coverage when they are driving non-owned vehicles. It fills the gap since the vehicle owner's policy is primary but may not fully protect the driver. It doesn't cover physical damage to vehicles, that's on the owner, uninsured vehicles, that's or excluded drivers, that's policy-specific. Non-owner is liability protection for frequent non-owners. Next question. What is the primary purpose of a binder in insurance? Is it A, a temporary agreement providing immediate coverage until the formal policy is issued? Or B, a file folder used to organize policy documents? C, a document that binds the agent to a specific commission rate? Or D, a form used to cancel a policy? The answer is A. When someone needs insurance coverage right away but the full policy paperwork and underwriting aren't complete yet, the agent or insurer issues a binder. This is a short, temporary contract that provides immediate coverage starting from a specified date, often the application date, until the formal policy is issued, declined, or a set expiration date. It is legally binding like the eventual policy and protects the applicant during the gap. Binders are not physical folders. They have nothing to do with agent commissions. They are not cancellation forms. The primary purpose is to grant instant, interim protection while the permanent policy is prepared. Next question. In a commercial general liability (CGL) policy, what does occurrence mean? Is it A, an accident, including continuous or repeated exposure to substantially the same harmful conditions? Or B, a single, sudden event only? C, any claim made against the insured? Or D, an intentional act by the insured? The answer is A. CGL policies are occurrence-based, meaning they cover liability for bodily injury or property damage caused by an occurrence during the policy period, no matter when the claim is filed later. The standard ISO definition describes an occurrence as an accident, something unintended and unexpected, and it specifically includes not just one-time events, but also continuous or repeated exposure to the same harmful conditions, like ongoing chemical leaks or repeated noise damage that slowly builds up harm. This broad wording captures both sudden accidents and gradual processes that weren't deliberate. Limiting to single sudden events ignores the continuous exposure part. Claims made is the trigger for claims made policies, not occurrence. Intentional acts are usually excluded because they aren't accidents. Occurrence covers unintended events, including ongoing exposures that cause harm over time. Next question. In the context of insurance, what is a valued policy? Is it A, a policy where the insured and insurer agree on the property's value up front for total loss purposes? Or B, a policy that is highly valued by the insured. C, a policy written at market value. Or D, a policy that automatically increases in value. The answer is A. Valued policies, or valued policy laws in some states, treat the stated limit as an agreed value for total loss from covered peril. The insurer pays the full face amount regardless of actual replacement/market value at loss time. This presets payout and avoids valuation disputes. Not personal high value. Not market value. Not auto-increasing. Valued policies fix the total loss settlement at inception. Next question. What is the purpose of an installation floater? Is it A, to insure materials and equipment while they are being installed at a job site? Or B, to provide liability coverage for installation work? C, to cover installed equipment after completion? Or D, to float the insurance premium during installation? The answer is A. Contractors risk damage to property they are installing, e.g., machinery, fixtures, HVAC, during transit and installation. An installation floater, inland marine, covers that property against physical loss from covered perils until the job is complete and accepted. Post-completion is property or completed operations, not liability, not premium float. Installation floater protects materials/equipment during the installation phase. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.